Hello, everybody. So today I want to talk about StoneCo Stock. STNE has reported earnings yesterday, and the stock was down about 10% after hours. And at the end of the day today, it's down a stunning 7% roughly, right? 6.8%. I'm being sarcastic, of course, because I'm showing the past year performance for this stock, and over the past year, it is up 82%. Today, down 6%. I don't think we can read much into it. The only thing we can read into it was, you can see that from an analyst question. It seems like much of the reason of the drop, and analysts having received question from a client or two was saying that it's because the founder of the firm, Andre, founder of the firm in 2012, that founder is stepping away from his role on the board and his role as the chairman, but will be electing the next chairman and stays really involved in the company. But today he really only owns 7%, not moving away from the company, but just not the chair of the company anymore. So STNE is not a founder-led firm anymore, and this is the reason why the market, I think, is worried, is if they just have the founder who's not going to be the chair of the board anymore. I don't think it's a big deal. When I started my position in this stock, in this company, I knew that it was not founder-led anymore. We know that some people, some investors refuse to invest in companies that are not founder-led. If that's a problem for you, I understand why you would not be interested in StoneCo. But moving on to StoneCo, there's two more things that I want to say. As far as their competitive advantage goes, we've received more information. If you read the letter to shareholders, you know that they see their competitive advantage. They see their advantage in the marketplace as three things. One of them is that they are a very vast reach, right? More than 3 million small businesses use them. But we got new info, including 5,000 cities. They are in 5,000 cities, covering 99% of the service GDP in Brazil. So this is a pervasive business. Of course, the people who use STNE may use other services as well. It doesn't mean they just use STNE, but they are STNE enabled, right? 5,000 places have STNE over there working for them. Then they identify superior service as the reason for why they're doing well. If there is a problem with a payment, they answer the phone in less than 5 seconds. One thing that comes to mind with this for me is what's going to be the role of generative AI in the coming years for a company like STNE. Are they going to be able to save a bunch of costs because maybe they're going to have Gen AI respond the phone whenever there's a problem instead of having real human agents? But anyways, because of that, they're a leader in customer satisfaction. There's other stocks I invest in, for example, like Enphase, who have similar great customer satisfaction service that helps them win in the marketplace. And the best example of a customer-centric company obviously is Amazon. Amazon putting the customer at the center. That helps drive sales. And lastly, they're moving towards a platform, and a platform that's what we saw the last time, the last investor day, and the last time I covered it, I was showing this. This is what they mean when they have their brick approach between today and 2027. They want to move to an approach where they are a platform and they can serve many needs from the firm, from an ERP type software for a gas station to the bank, to the credit, and to the payments. So they have this vast expansion plan, and that's what they call their merchant platform that's going to enable them to do much more than just payments. Another thing that I wanted to add is that they are sharpening their strategic focus. This is a company that's driven by efficiency and that wants to become more and more efficient. They did a few changes, like a zero method budgeting, a zero budget and cost management methods that they've implemented. That's one aspect. Another aspect is organizational structure redesign so that there's clear manager-employee relationships. But they've also sharpened their strategic focus in one way that I think is interesting, is that they are offloading customers that bring less money. They are offloading some costly customers, and they're focusing on the key verticals. And it's even more than the 80-20 for them. It's more like a 95-5 for them. And this vertical, most of their business comprises retailers, gas stations, food stores, and drug stores, which is a lot of businesses. That's a lot of businesses in Brazil. And so I think that's going to continue going forward. And StoneCo, of course, is more than, say, for example, a company like Toast, who only does food. No, they do much more than food. And I think it's very wise to concentrate on your biggest segments. When we look at the strategic priorities that they talk about, how are they going to grow? Well, one of them, of course, is to keep gaining new customers, new clients in the marketplace, in the medium-sized and small-sized businesses, payments business, total payments business. You can see, I'll get to this in a second, but they increased their client base to now 3.5 million. They have 3.5 million customers that have the device. In 2023, they had 945,000 businesses using StoneCo. So this is a company that's growing very fast as far as the base of client goes, growing also very fast from a transaction processing volume here, and it's 20% year over year. Of course, another thing that they want to say is they drive engagement, and for that they want people to use the product. This is what they're calling making money. They make their money their way, and they're trying to make money by increasing the take rate, by restarting the credit portfolio, although I'm not including this as anything meaningful. If anything, a lot of investors are worried that restarting the credit portfolio will make investors value StoneCo more like a bank and not value it like a payments company. I don't think that's a risk to worry too much about. I mean, Square in the US does the same thing. They do lending just the same, and a lot of other companies do that. So I'm not too worried about that. And then their platforms, scaling through platforms. Their platforms, that means selling more to the same customers, expanding the platforms. And if you look at the business is doing well. It grew 20% year over year as far as the total revenue goes. So again, not as high as I was expecting. I'll easily admit that, not nearly as high as I was expecting, but still much higher than most businesses that are available out there. For the businesses I cover on the channel, it's a little low. I was hoping for something better, but this is a company that's focusing on profitable growth and profitability. So the adjusted net income is going up much faster than the total revenue. Same for their EBT, growing faster than revenue. This is a company that's focusing on growing its profits more than it is focusing on growing its revenue. I like to see companies focus more on growing revenue as well as the rest, but that's not the market that we're in right now, and that's not what the pressure of the shareholders. The shareholder pressure is not towards that, which is too bad in my view. But that's okay. The payments client base, this is still growing in hyper growth mode. That's at 37% year over year growth. Almost 3.5 million small businesses use STNE. I love to see that. These are client base that are getting onboarded, and that with time will spend ever more money on the platform. Transaction volume is up 20%. Take rate is up very, very slightly, but they guided that it will be more up, leaning towards 2.5%. I mean, this is small, of course. And they are starting from a very low base on their credit, a little bit of a higher base on their banking, but I want to pay your call your attention to their banking service and their banking product. If you look, they've increased client deposits by 50%, so that is really good right here, and they've increased active clients by 3x between 4Q 2022 and 4Q 2023. That's a 3x, right? From almost 700 million to almost 2.1 million and 700,000, sorry, not million. So they have a lot of small businesses that are taking on that banking offering, and they are going to make the average revenue per user, it took a slump, and I don't really know why it did that, but it's gonna go back up and move back up the revenue per banking users. So they are growing that banking segment that you see right there in this chart that they released on Investor Day. They are growing banking. This could yield some exponential growth, and of course they are also growing their loans and their lending. They did a 2.7x to their lending, keeping in mind that this is not too meaningful just yet. At 309 million reais is not that high for now, especially given how much cash they have on the balance sheet. They are still not in the stage where this is meaningful, but of course they are putting some loan money aside, loan provisions for their non-performing loans, and they've worked so many years to try to improve the credit portfolio and try to improve their credit lending standards so that they don't have defaults like they did back in 2021. And even though the market is still scared about this is a way for them to grow revenue quite a bit, because a lot of people want to borrow money, and if you can find a way to lend money safely to them, you can grow your business quite a bit. But I'm not counting either of this revenue in my general estimates of revenue growth, which I'll get to in a second. As I like to joke, company is in the cash piling business. They are still in the cash piling business. They have now at 5.1 billion reais total. That is exactly $1 billion of net cash on the balance sheet. So this is a company that is cash rich and can finance its operations. It's a $5 billion enterprise value company. So about 20% of that is cash on the balance sheet. Keeping in mind they have a little more than 700 million of long-term debt. So this is also something to keep in mind, but nothing too concerning in my view. Now, the new CEO has been there a year in, and the new CEO guides in a way that I don't really like. They don't guide on revenue anymore. They're guiding to the bottom line. And so that makes it much harder for me, because I'm a revenue growth type of guy. I'm all about revenue growth. So this makes it a little much harder for me in my spreadsheet. One thing about the guidance that they've reiterated today, in the report yesterday, is that it is the same as the one that was given on Investor Day. So the guidance has not changed, which is very reassuring. The market would have been worried if the guidance changed. No, the guidance, they're sticking to it. It's the same guidance. So the video that I made a few months back talking about a 3.9x in a four-year period, theoretically, that video still holds if I can achieve that end of 2027 growth numbers. That's still an outstanding return over the long run. Transaction volume and net income growth guide, it's 18% for 2024 and 22%. So this is a business that's roughly growing at a 20-ish% rate, guiding for 2024, except for their credit portfolio. They're guiding a growth of 160% in their credit portfolio. That's a 0.6x. So we're gonna see hypergrowth when it comes to the credit portfolio. We're going to see some hypergrowth of that, and we'll have to see whether the market likes that or not. As far as I'm concerned, that doesn't bother me. I find that I find it good that they're getting back into this and they fixed their issue. Especially as we see more interest rates drop, this is going to be a very profitable business for the next years to come. The lending business, in my view, once again. So, what can I say? Well, let me tell you this. Yes, clearly 40% revenue growth is too high. Expecting 40% revenue growth, I was just reusing the analyst number in my prior videos. That is too high. But the question is, what's revenue growth actually going to be? So this is how I'm gonna calculate it. My conservative view on revenue growth is that it's gonna be 21% over the next 12 months. How do I get to that? Well, the transaction volume they guided 18% growth in the transaction volume. So revenue growth theoretically should be at least 18%, right? Assuming the take rate doesn't change much, that should be at least 18%, but I'm going to assume that there's going to be a slight take rate expansion. They've guided for that. So they've guided for a slight take rate expansion, so that leads us to 90% if you round it up. And then from 19%, we do know that StoneCo is offboarding, as they say, some non-profitable customers, but given that over the past 12 months in 2023 they grew the number of clients by 37%, I think it's naive to assume that the clients are not going to grow. There's going to be more clients too. And so my assumption for that is that they are going to see about 10% more new customers in 2024. So in my view, if I just increase that by my 19% number by 10%, I'm getting at a 21% revenue growth, and that's what I'm going to assume, that this business is growing at 21%. I mean, not all that different from the 18%. And this is where this business shines because, as you know, if you follow the channel, my spreadsheet penalizes greatly companies that don't have high revenue growth. If you don't have high revenue growth more than 30%, you're going to be penalized by my spreadsheet. So I consider STNE to be penalized at a 21%, and it is still showing a very, very, very cheap number at a 0.13, and it is still showing a rule of 40 with 67. What does that mean? EBITDA margin 46%. What that means is that this is a highly profitable take rate business that I'm happy to own. I'm happy to see them implement, probably more buybacks in the year to come if they don't want to spend that money on lending or on growing the business in other ways. And I'm getting there by using 21% revenue growth, right? Enterprise value over revenue here is a 2. This is a business that's roughly trading at a 2 times sales. So that's very cheap for that type of business. Now, if you start assuming 30%, you are getting at a 0.09, so that would be cheaper than a stock like HIMS. And if you know this channel, HIMS is a stock that I enjoy very much and talk about very much. And if you assume 40% growth, that business would be a 0.07. So again, twice as cheap as what I'm seeing it right now. So very cheap business. Definitely still top quarter. It is still rarefied air. Very rarely do I show you a business that has a 0.13. Very rarely. So this business is still dirt cheap. And as a reason for that, even though I am disappointed by that revenue growth, that's not going to be 30+%. I'm disappointed by that, but this is not enough of a reason, no reason for me to take a profit, especially because I'm up on the stock. And because I'm up on the stock, I would have paid capital gains. When I buy a stock, it's I like to think for a decade, at the very least, unless something changes, this company has guided until 2027. That's a long-term guide, and I'm a long-term investor. And so right now, I am waiting until 2027, 2028 to see what they're guiding then and where they're at, and to see if I'm taking profits then or staying on that journey. But for now, I am definitely staying on the STNE train. And keep in mind that that is all knowing that some of the stocks that I like better are not that cheap right now. All bets are off if HIMS goes back to $6 or Tesla goes to 100, or if some other stocks become super cheap. All bets are off. I am trying to concentrate my holdings, concentrate my portfolio right now on my best convictions, and that is because interest rates will drop this year, and we know what happens to the market when interest rates go down. So anyways, this was obviously not investment advice, no financial advice. I love Costco just as much as I always have. I don't think the movement of a stock is that meaningful. But today, no financial advice, no investment advice, and never that, not just today. This is entertainment. I hope you were entertained. Please like, please subscribe. Thank you for watching, and have a wonderful day.